Okay, folks, welcome to the Contrarian Trader and my market commentary. It's going to be a pretty bearish video, as was my last one. The last one I posted was on January the 20th. And to get my weekly updates and to get these videos in the future, enter your email address. If you're watching this on the website, you will not be spammed. We hate spam too. If you're watching this on Stock, Twitch, or Twitter, please follow me. Or if you watch this on YouTube, please subscribe to my channel. So let's begin with Dow Jones Industrial Average. And from that last video, I had no idea how right I was going to be on the market, because the next trading day, we went into an 8% correction on the Dow Jones Industrial Average, and we were short. At the time of that taping, we were net short of the overall stock market, short using the TZA, the Direxion Leveraged ETF, which puts you short of the Russell 2000 3 times. It's a leveraged ETF. We made a ton of money. And all the way up, each time we hit the upper band of the rising uptrend channel, we were booking profits, and we were pretty much out of our position by the time we peaked out at 1959. And we've since come all the way back and now broken down to even lower lows than where we were in September. We were also long of the TVIX, which is basically puts you long of volatility, and this is a leveraged ETF, so it moves twice the move of the VIX. And we saw an increase of over 100% on that trade from my taping on September the 20th. So again, some very, very big gains, and we pulled back, and we've now broken down to lower lows. I also mentioned at that time the gold mining names, specifically the GDX. Beware, stay away, due to the fact that at that point in time, we were topping out. Note the topping tails at resistance to 21.93, and we pulled all the way back from those levels down to $16.45, a huge, huge pullback. So we made a pretty bold call, and we were right on our call. So what does that mean? I'm now bullish on the market? No, not at all. I'm just as bearish, if not more bearish now than I was back in September. And here's why. This is the same chart I led off with in the last video. It's a quarterly chart of the Dow Jones Industrial Average, and we are in a trading range. And in this trading range, we have an upper band and we have a lower band. Each time that we hit the upper band of the rising uptrend channel, we have gone into a major correction. The first time was in 2000. The second time was in 2007. The last time was in September, and that's when I made my video. This is the proximate cause. We hit the upper band, and I made the video, and I said, look out below. And that's when we got the 8% correction on the Dow Jones. But that being said, I also said we were not deviating from our position that we will probably hit 17,500 on the Dow Jones Industrial Average. If you want to take a complete view of that video, it's still posted on Stock, Twitch, or my website. You can go back, check it out, posted on the 20th of September. And I also warned that we could rally through this upper band of the rising uptrend channel, and we have since pierced it. That prophecy has been fulfilled. The last time we saw that event occur was back in 2000. And what you're looking at here in black line chart is an overlay of the Investors Sentiment Index. What is that? It's basically the sentiment of money managers, bullish or bearish, and this is the bearish sentiment. So you can see that we are at multi-decade lows. Let's move on. Next chart up is the total market advanced decline line. Very, very critical. In blue line chart, I have overlaid the S&P 500. Now, for the most part, the advanced decline line, if those folks that are not familiar with the advanced decline line, during a bull market, you generally want to see the total number of advancers outpacing the total number of decliners. And you can see that for the most part, as the S&P 500 rallied, the advanced decline line rallied along with it. However, that correlation has been broken. And you can see that while the S&P 500 has broken out to all-time highs, the advanced decline line has stalled. Now, can this change next week? Sure it can. But at some point in time, there will be a reversion to the mean. they will trade in correlation once again. So that means either A, you need to see a breakout on the advanced decline line, or B, you need to see a correction in the U.S. stock market, in this case the S&P 500, to get back to a traditional correlation. And for those folks that are saying, Bob, the Russell 2000 has underperformed the overall stock market, you said so yourself, you were short of it. Can't that be holding back the advanced decline line? Let's take a look. All right, so here you have overlaid in orange the Russell 2000, the S&P 500 remains overlaid in blue, and there is a good argument that the Russell 2000 is holding back the total market advanced decline line. However, the flattening out of the Russell 2000 and the appearance that it may just roll over can't be ignored. And the historical correlation of the S&P 500 trading along with the advanced decline line can't be ignored either. So again, I'm going to stand by my call that at some point in time, we need to either see A, a breakout in the advanced decline line, or B, a correction on the S&P 500 to get back to the traditional correlation of them trading in tandem. Let's take a quick look at the S&P 500 on a monthly chart. We are very overbought. We can get more overbought. I've seen worse, like back in 2000, back here, also back in 2007. But never have we been so extended on the U.S. stock market with, again, this is the investors' sentiment gauge of money managers. These are the guys that are managing your retirement accounts. They are asleep at the wheel. Never have we been this extended in the U.S. stock market with so much complacency, so much lack of fear by money managers. It should be a concern to everyone out there, and it's a recipe for disaster. Now let's take a clear view of the Investors Intelligence Bears Index. Again, a survey of money managers. Are you bullish or bearish? And you can see they are at lows not seen since 1987. I think we had a crash at that time. And we have been in a trading range. We hit the upper band, we pull back. We hit the lower band, we rally. We have broken down below the lower band of this downtrend channel. So while the stock market has gone parabolic, the money management community has gone into a coma. And I kid you not. So I've outlined what the condition of the overall market is, how extended it is on the stock charts, on both a quarterly and a weekly basis. I've laid out the overall psychology of the stock market, of money managers. You want to take a look at the VIX? Let's take a quick look at the VIX, the volatility index. Here we have it, the weekly chart of the VIX. Prior to the sell-off in September, we hit a low on the VIX of 11.24, then rallied up to 31.06. At this point in time, we were 2 times long of the VIX using TVIX. And we are now back down below 13 once again, and we appear poised, ready to head down even lower, which probably means that we're probably going to see some continuation movement higher on the S&P 500. So what is the concern? I've been voicing to my members the concern for me is on several fronts. These could be the catalysts that set the wheels in motion for a stock market correction here in the United States. Now, on Friday, the Bank of China, People's Bank of China, came out and they cut rates. The European Union did some jawboning on their own, and that sent the stock market higher here in the States. So when I took a look at the futures market on Friday morning after the news was announced, the Dow futures were up about 115 points, and I said, wow, this is an opportunity. This is a great opportunity because this is going to set the stage for a blow-off top in this overall market. And I sent out an alert, a morning update to my members saying, okay, we have the Dow futures spiked higher by 115 points minimum. They're going to open it up strong. The only question I'm going to pose to everyone is this. Does this look like a stock market that's been worried about China? Obviously not. And if we weren't worried about China, then why would a rate cut in China cause a spike higher in the U.S. averages? And I warn, do not go chasing stocks into the open. Expect a pullback. And sure enough, we had 17,900 and we pulled back. I'm not going to be a bit surprised to see that 17,900 is the high for the year. So a big topping tail on the Dow Jones Industrial Average. If you wanted to take a look at the IWM, which is the tracking ETF for the Russell 2000, a hollow candlestick, meaning it closed well off the highs of the day, and at one point in time we were actually negative on the day. So what this was an opportunity for institutions to go in and sell into the dumb money that the news media got all excited on Friday morning on the heels of China's announcement. Up volume did rise. However, a lot of it was selling. So I have my opinions upon where we're going to proceed from here, and I will be going over that with members on the week ahead commentary, which I'll be sending out to them on Sunday. And the week ahead commentary, 2 videos. One is the market pulse check, which is a review of the overall averages, and the other is the focus stock analysis video where we review trades that we're looking to put on and trades that we currently are into. And again, that goes out every Sunday. All right, so what is the possible fuse or catalyst that sets off this time bomb? China. I've been warning members for quite some time now about China, and up and until the Friday announcement out of the People's Bank of China that they were going to lower interest rates, we were down considerably lower on the month on the FXI, which is the tracking ETF for the top 25 companies in China. So we still remain down net on the month even after the rate cut, and on a daily basis, we closed well off the highs of Friday. So China is a major concern. If they begin to break down, and they break back down into this pennant formation, that is a breakout point failure. It means that this breakout has failed, and the probability of it taking out the lower band and heading significantly lower is very, very strong. That could be a catalyst. And why should China still be a concern? All you need to do is take a look at Australia. Australia provides China with the vast amount of raw natural resources it takes to build their ghost cities. And Australia, on a monthly chart using the EWA, has broken down severely. Here we had a strong uptrend. We broke down below the lower band of the rising uptrend channel. And if we break down below 2317, we're going a lot lower on the EWA. So always keep an eye on the Australian iShares, because you never really can trust what those Chinese are doing because it's such a managed economy. What you need to do, among other indicators, is take a look at the Australian iShares. What else is out there? Well, all you need to do is take a look at a weekly chart of the high yield bond market. In this case, I'm using the BlackRock High Yield Bond Fund for no other reason than it's just a good illustration of how the high yield debt market is really beginning to fall apart. Now, we were in a very, very long uptrend. We broke that uptrend. We've since rallied off the lows of 7.98. We were lower last week. However, the news out of China sent the high yield credit market higher. Why? It's because a lot of the high yield debt is debt from the shale oil players, the US based, the Canadian based oil producers. And if the price of oil continues to decline, those companies come under great pressure. And so the threat of defaults on these high yield bonds rises as well. And that's why you're seeing a pullback in the high yield bond market. So this is another bubble that's out there. It's not spoken about much on TV. You need to watch the charts, folks. And that's what I teach my members. Lastly, what's out there? The U.S. Treasury market, the 10-year note, is a big concern. This is a monthly chart, and you can see that we have a potential for a head and shoulders setup. Left shoulder, head, right shoulder. This topping tail or selling occurred back in October. What happened in October? The Federal Reserve ended QE. Now, this is a double-edged sword. Now, while the decline in the 10-year yield in the short term bodes well for the U.S. stock market because a lot of that money will rotate into the U.S. stock market, it also means that interest rates will move higher. And once you get yields moving past 3.5%, 4%, it's not going to be good for stocks any longer. There is no real growth in the U.S. economy that will allow it to withstand rising rates. Why is the U.S. economy growing at all? It's all because of QE, and QE has ended. And we have engineered interest rates lower than where they should be. If they truly believed that the U.S. economy was growing organically at 3%, do you really think that they would have interest rates this low? So if you see a breakdown on the Treasury market, while it may not be bad in the short term, I mean, look, we pulled all the way back off the highs, and the U.S. stock market is trading at all-time highs. It doesn't mean a death knell. What it could mean is that if we get a structural breakdown below this neckline, it could mean that the acceleration of rates spooks the market, and that could send stocks lower. So besides all the geopolitical risks, Russians with tanks in the Ukraine, the Chinese in the South China Sea redrawing their own maps, there are a number of different catalysts that could begin to cause this market to roll over. Now, is it going to happen tomorrow? No, I doubt it highly, but I do believe that it will occur before the end of the first quarter 2015. But until then, we have no problem with keeping longs on the table, staying long of the market, building short positions when the opportunity presents itself, and position ourselves to the short side as we did back in September. And why I view the short side as so attractive is that it took only 20 days to take away all the gains in the market from February of 2014. 20 days to take out several months worth of gains, and I expect to see that again, and we will be short of the market. And that's it, folks. Again, if you watch this on StockTwits or Twitter, please follow me. If you watch this on YouTube, subscribe to my channel. And if you watch this on my website, enter your email address and get these alerts in your email. We hate spam too. You will not be spammed. Everybody have a great trading week and happy Thanksgiving.